Cash versus accrual. Which accounting method is best for running a business? So the accounting world actually provides two different methods for recording revenue and expenses. And it really boils down to cash versus accrual. Please do not stop watching the video. I promise this will be quick and painless. It's important for you to understand the difference between the two accounting methods. So that way you can join the conversation when you meet with your bookkeeper, your CPA, and your banker. Plus, you need to really understand which viewpoint you're looking at when you review your financial reports, either weekly or monthly. And just so you know, there's a little bit of a spoiler alert. This is actually just a timing difference. The difference in the two methods is simply when you record revenue and when you record expenses. Your choice affects not only your financial statements, but also your tax return. So first up, let's start with the cash method. So the cash method works the way the name implies. It follows the flow of cash moving in and out of your business. So revenue is recorded when you actually receive the payment from your customers. So here, let's look at an example. So from a revenue standpoint for the cash method, let's pretend that you mailed an invoice to one of your customers for a project that you've already completed. So the actual invoice for the customer is dated May 14th. The customer actually mails you a check and you deposit that payment on August 1st. Because you're using the cash method, you would actually record the revenue on August 1st. Let's also dive in and look at an expense, the expense side of the cash method. Expenses are recorded when you actually pay your vendors. So let's pretend that you received a bill from one of your vendors. It's dated June 1st. You're paying your website designer for a little bit of work that they performed for you. You're actually going to mail a check to them on July 15th. You would record the expense on the cash method. It would hit your books on July 15th. The cash method is actually very similar to your personal finances. Whenever you receive an actual deposit in your personal bank account, that's when you would record it in your budgeting system or Quicken, however you, or your manual little check register. However you record your personal finances. When you actually write a check to pay your mortgage, you would use that same date to record that transaction in your checkbook. The same logic applies to your business checking account if you use the cash method. When cash changes hands, the transactions are recorded in your accounting system. You're essentially tracking the transactions based on the activity that you have in your business checking account. Let's dive into some of the advantages of the cash method. First, it's very simple to maintain because it's super easy to determine when to record the transactions. Also, your profit and cash are more likely to align with each other. When you're looking at your profit and loss statement, it's only going to show revenue that you've deposited in your bank account. It's only going to show you expenses that have actually left your bank account. So that's going to be aligned a little bit better for you, but you still need to consider if you've used any of your cash for any transactions that are not reported on your profit and loss statement. Those transactions are reported on your balance sheet, and that would include your principal portion of any loan payments, if you've replenished any inventory, bought any new assets. Those type of transactions you would still need to consider, but the bulk of the information would be better aligned with this cash method. You have more control over your tax planning. You can delay issuing customer invoices until the first week of January. You can also prepay expenses in December. But keep in mind, this primarily works that first year because you're able to manipulate the timing of that revenue and expenses. But you'll have to repeat those same tactics the next tax year in order for you to see the same benefits. Otherwise, it's just a timing issue. So I would not hang my hat too much on this one because it's hard to kind of play around with that on a consistently annual basis. With the cash method, you're more likely to have the cash that you need to pay your income taxes. So if your only revenue is based on what you've actually received from the customer and your expenses are only what you've actually paid, then you're more likely to have that money left over in your bank account. Now, when you use the accrual method, we'll go over that in just a few minutes, but the accrual method, it's quite possible that you might have profit reported on your financial statements, but the profit is actually stuck in your accounts receivable balance. It has not been converted to cash. So that's kind of a cash flow issue that can pop up on the accrual side, but it does not on the cash method just because of the way you're naturally recording those transactions. Now, this might sound really good for the cash method, but here are some of the disadvantages. So the lack of the matching principle makes it very difficult for you to easily see whether you've made money or not. So just imagine that you have worked on a project for one of your big customers and you have payroll expenses 1 week. The next month, you're paying vendors for some supplies that you used for that project. And then 45 days later, you actually receive the money from the customer. You could have transactions for that project cross over 3 months. And that makes it very, very hard to actually see, have you made money? Which is, have you made money is actually one of the biggest financial questions that you need to be able to quickly answer in your business. So that way you can confirm that those sales have turned into profit and you've converted that profit into cash. So the cash method makes it a little bit difficult to do because you're not able to easily match revenue to the expenses that are directly related to that project or to that same time period, depending on what you're looking at. Also keep in mind that the balance sheet does not include two very important accounts receivable and accounts payable. Accounts receivable is the actual kind of holding account that helps you track which customers owe you money, how long have they owed you money, and how much. Accounts payable provides you the information with which vendors do you owe money to, when are those payments due, and how much do you owe. So when you use the cash method, you would actually need to track this information either with a notebook, Excel spreadsheet. You would need to manually track that information, which just adds a extra level of complexity. And there's possibility of errors because someone transposed a number or something bad happens with tracking that information. Also keep in mind that if you're not able to easily see who owes you money and who you owe money to, it makes it very difficult to manage cash flow. Also, it provides a very incomplete short-term view of the company's business finances. You're pretty much tracking your business based on the bank account, and that is very short term. You need the ability to be able to see where the money is going, not just what is the balance today. When you actually use the reports of accounts receivable and accounts payable, you can actually start to see where that money is going to be for you in the future, where you can better manage cash flow. Let's dive into the accrual method. So the accrual method fixes the timing differences that are naturally in the cash method. The accrual method requires you to record revenue when you earn it, regardless of when the customer actually pays you. And expenses are recorded when they are actually incurred, regardless of when you actually pay the vendor. Typically, you earn revenue when you provide a service and you have a good reason to believe that you will receive payment. You've delivered what you promised The customer is happy. The invoice date on your customer's invoice determines that date your company recognizes the revenue under the accrual method. Since the accrual method records transactions before cash actually changes hands, your accounting system will automatically charge accounts receivable and accounts payable. Think of both of those accounts as kind of like a holding account. They take the place of cash until the cash actually changes hands. So when an invoice is created for a customer, your accounting system will automatically increase accounts receivable and your sales account. The amount your customer owes you is recorded in that holding account, accounts receivable, until you actually receive the payment. Then that creates that accounts receivable report, so that way you can easily track the customers that actually owe your business money. Let's look at an example. So we've got the accrual method and we're recording the revenue. These are the same dates and amounts from the previous example. So on May 14th, we mailed an invoice to a customer because we have finished that project. On August 1st, the customer actually paid us. We actually deposited that money into our bank account. Because we're using the accrual method, we report that revenue, we recorded in our accounting system on May 14th when we actually send that invoice to that customer. From an expense standpoint, we're going to follow that same logic, except for the invoice date on the vendor's invoice determines the date you actually recognize the expense. So here we've got the same dates and numbers as the previous example. We've got accrual method for the expense side. We received an invoice from our vendor that was dated June 1st. We actually mailed the check on July 15th. The expense under the accrual method is going to be recorded in our accounting system on June 1st. When a vendor invoice is entered into the accounting system, the expense and accounts payable accounts both automatically increase. So the amount that we owe to the vendor is recorded in the holding account, accounts payable, until we actually pay the invoice. So by entering the expenses with the accrual method, we're allowed to see how the expenses match to the revenue that has been generated. This allows us to look at the accounts payable report and easily track the vendors that we owe money to, and it will allow us to project what our cash flow will look like. Here are some of the advantages of using the accrual method. First, the balance sheet is more complete because it includes accounts receivable and accounts payable. You have a more accurate picture of profitability on your profit and loss statement because the accrual method naturally matches your revenue and profit to those related expenses. And your accounting system will automatically track. It will generate reports for you where you can easily see accounts receivable by customer and accounts payable by vendor. You'll quickly see red flags before they become an emergency. When you're using the cash method, you have to rely on so many manual systems in your memory, and it can be a mess if you're relying on your bank account to give you a lot of information. This actual accrual method will allow you to see, hey, sales are going up, but why is profitability going down? You can quickly start comparing information and use the reporting system to help you pinpoint what that problem is, and you're more likely to fix the problem before it becomes a major emergency in your business. Here are some of the disadvantages of the accrual method. First, it may require a little bit of training for you, your office staff, even your bookkeeper. It depends on how familiar they are with the accrual method. The good news is once you kind of create what that framework is, it's a very easy, repeatable process where you can design a system around it for your accounting or bookkeeping staff. So do not let that overwhelm you. It can get a little bit complicated, but it is totally a system that you can create in your business. One of the main disadvantages of the accrual method is your profit and loss statement could report a profit, but in reality, you're actually running out of cash. The problem with this is a lot of business owners like to focus in on their sales. Ooh, sales are increasing. That's awesome. They look down at the bottom line. Hey, I'm profitable. Everything is good. But in reality, if you are not taking it all the way to the cash finish line, if you are not converting your accounts receivable balance to cash, you are in jeopardy of running out of cash. So you've got to take your focus off that one report and really look at that accounts receivable report so that way you do not run out of cash. You can have a false sense of pride when you are looking at that profit and loss statement and you see all this profit. You've got to really take that extra step and invest time in converting that profit to cash by actually collecting that accounts receivable from the customers. You may also have to pay tax on revenue that has not converted to cash because the customer has not paid yet. Their balance is actually stuck in the accounts receivable account. So this is definitely something that you want to be aware of when you are using the accrual method. You want to be very mindful of having the cash reserves that you need based on the actual profitability from an accrual method, not necessarily what you've actually deposited in your bank account. Here is a quick comparison little spreadsheet for you to consider when you're trying to look at the pros and cons of the cash method versus the accrual method. This little chart is actually embedded in my blog article as well, if you just want to take a screenshot of it there. From an operational standpoint, the cash method really helps you look at it from a cash flow standpoint. The accrual method is most valuable from a profitability standpoint. So you may be thinking, which method should I use for my business? Either cash or the accrual. And so even though we've never met, I encourage you to consider using the accrual method for operations and the cash method for tax purposes. This is actually the best of both worlds. Yes, you can actually choose the method that you use for your operations, and it can be different than what you use for preparing the tax return. The financial statements are your financial statements. It is important that you choose a method that supports your ability to quickly make financial decisions. And don't worry about paying higher tax return preparation fees. Most accounting software packages will allow you to automatically track both methods. And so a tax accountant can either print it in the other method when they're preparing the tax return, or they can make just a few minor adjustments to get what they need to prepare the tax return. This is not a huge expense. Trust me, it will save you so much more money on the long run. It will reduce your financial stress if you use the accrual method for operations, and then rely on your tax accountant to provide you with the guidance that you need from a tax standpoint. Which method does the IRS require your business to actually use? So keep in mind, this is very generic information. The guidelines that are issued by the IRS mention that you can actually use the cash method if your annual revenue does not exceed $25 million and your business does not carry inventory. So talk to your tax accountant to really learn what those guidelines are for your business. We're going to dive into an example. So here are some of the transactions that we could have during the month of December. We actually provided $10,000 of services. We received a $2,000 payment from a customer for the services we provided last month. We paid $1,000 in labor related to the service we provided this month. We received a $3,500 invoice from our material supplier. We received a $250 invoice for office supplies, and we actually paid $2,000 rent for the month. So look at it from a cash method standpoint. If you are using that method, which of these transactions would actually hit your reports during the month of December. So go line by line and just think about which ones would actually be reported. Remember, the cash method, you're actually recording transactions based on when cash actually changes hands. So when you receive the money from the customer, it gets reported. When you actually pay the invoice to your vendors, you actually mail that check, that's when it's recorded in your accounting records. So which of these transactions would be recorded in the month of December because cash actually changed hands during the month of December? So the first one provided $10,000 of services. If we haven't received any payment, then we would not record that. For the cash method, we would record that $2,000 payment because that's actually cash changing hands regardless of when those services were provided. We paid $1,000 in labor, so that payroll actually happened. $1,000 left the bank account. That transaction is reported in December. We received an invoice from our material supplier. Does that one get recorded? No. If you answered no, you are correct. Money has not changed hands just because we received that invoice. It's not going to be recorded on the cash method until we actually pay that invoice. What about received an invoice for the office supplies? You are correct if you cross that one off of your list, because on the cash method, we would not record that transaction yet. We have not paid for those office supplies. What about rent? You are correct. We would record that transaction because we actually paid rent for the month. We actually mailed that payment to our landlord. So let's look at it from a profit and loss statement for those transactions. So we were able to cross off 3 transactions that go through our accounting system that is not being reported on that cash method system. So we've got the $2,000 up in our revenue account. We paid $1,000. It's showing up in our cost of goods sold for our labor. And then we reported the rent that we paid, $2,000. So according to our profit and loss statement, if we're looking at the viewpoint, the accounting method viewpoint of cash, we had a loss that month of $1,000. So our net income is actually negative $1,000. So let's see what it would look like if we use the accrual method. So I've got all the exact same transactions, and I want you to think about which of these transactions would we actually report on the accrual method. Remember, under the accrual method, we report revenue when we actually have earned that revenue, when we've delivered that service, that project is over, we've sent those invoices. When we are reporting our expenses on the accrual method, those are reported based on when it has incurred, when that expense has incurred, what is based on that vendor invoice. So let's go through the list. You've actually provided $10,000 worth of services. Those projects are complete and the invoices have been sent to that customer. So we're going to keep that one. We need to record that transaction under the accrual method. Look at number 2. We received a $2,000 payment from a customer that we actually provided services to last month. Under the accrual method, we are not actually recording that transaction from a revenue standpoint. What's going to end up happening is you're going to deposit that $2,000 into your bank account. So your checking account increases by $2,000. But the other side of that transaction, your debits always have to equal your credits in the accounting world. And so the other side of that transaction is hitting your accounts receivable account. That customer no longer owes you money. So accounts receivable balance goes down to $2,000, decreases by $2,000. Let's look at that transaction number 3. We paid $1,000 in labor related to the services that we provided this month. We need to record that transaction. We received a $3,500 invoice from our material supplier. We need to record that transaction because we've incurred that expense. We've received an invoice for office supplies. We've incurred that expense, so we need to report it. And then we've also paid $2,000 for rent. Most likely you have to pay the rent in the same month that it's incurred, usually the first day of the month. So again, we would need to report that under the accrual method as well. So this is what the income statement would look like under the accrual method. Keep in mind it's the exact same transactions. We provided a whole bunch of services at $10,000. We had labor, but we also had materials of $3,500. We had office supplies of $250, and we had a rent of $2,000. So from an accrual standpoint, we look very profitable. We have net income of $3,250. Look at what a big difference the two different methods have on your reporting. We're on both sides, it's the same company, same transactions, same profit and loss statement. But under the cash method, we're losing $1,000. How discouraging is that if you are busier than ever, but you look at your report and you're like, wait a minute, how on earth am I not profitable? I set the right prices. My team was able to deliver that service on time. We actually shaved 30 minutes off of it. We were able to save about 10% on materials because of the way we were able to increase efficiency. How on earth am I not profitable? But then you magically look over here on the accrual method and your net income is showing that, hey, for those $10,000 of revenue, based on those transactions, we're actually profitable. This matching principle is vital for your operations. For you to truly be able to see whether you are operating at a profit, the accrual method wins hands down. So let's look at it from a project level. So you are providing one service to a customer, and I want to show how impactful the two different methods are at that detailed level of looking at that project for a customer. So let's pretend that on February 15th, we provided a $1,000 service. We mailed that invoice. So we were able to take care of that customer on the same day. Everything was wrapped up, nice little bow on the same day. On the same day, we actually charged $300 of materials on our account with a vendor. We actually had to place an order. We did not have the materials already in stock, so we actually had to charge that $300 of materials on account. We're going to pay our vendors 30 days from now. So on February 21st, we actually paid our employees $250 for this project through our payroll system. On March 15th, we actually paid that vendor 30 days later $300 for the materials that we purchased. And then on April 3rd, we collected the $1,000 from our customer. So from a cash method standpoint, which of these transactions are not going to be recorded? We're not going to report that revenue because we have not actually received the payment from that customer yet. So February 15th, that's not what we're going to look at. We're also not going to consider on February 15th when we charge that material on our account. We will record the payroll that was paid on February 23rd. We will record the payment to the vendor on March 15th. And in our accounting system, we will record the payment that we received from the customer when we collected that $1,000 on April 3rd. So this is what it looks like. In the month of February, the only thing that we're going to record is the payment to the customers. So if we only had that one project in our business, we would have had a loss during the month of February for the payroll that we paid if we were using the cash method. During the month of March, we would have had a loss of $300 because we would have paid the March 15th. We would have recorded the transaction for paying the vendor $300 for the materials. In the month of April, whoop whoop, we have a gross profit of $1,000, but we sure did forget about the losses that we had in the previous 2 months. So when you look at it from a cash method standpoint, this creates that roller coaster in profitability where in February we lost money, March we lost money, April magically we made money. But I need for you to look at it from an accrual standpoint. So when we're looking at the accrual method, what are the financial statements going to look like? We're going to look at it first from February standpoint. So when we're doing that, we're not going to consider what we paid in March or what we actually collected. The accrual method actually follows only when the revenue was earned and expenses were incurred, not when cash actually exchanged hands. So let's look at that project. During the month of February, everything magically just matches and reports the profitability of that one true project. Revenue of $1,000 is reported. Our materials, our labor, both are reported in the month of February. So we're able to see in the month of February, our gross profit for that project was $450. And then when you look at March, it's zero. April, it's zero, because when you actually pay the vendor, it doesn't matter. When you actually collect the payment from the customer, it does not matter. Everything is matched beautifully during the month of February when you use the accrual method. So here's just a little recap. Under the cash method, you're recording transactions in your accounting system. You are reviewing reports based on transactions that have actually gone through your bank account. And so revenue is recorded when you actually receive the payment from the customer. Expenses are recorded when you actually pay the vendor. Under the accrual method, it is actually a more complete picture where you are matching revenue to expenses because you are recording the revenue when you actually earn it. When you deliver the service, usually that's the same date as the invoice. Also, the expenses, they are recorded when you actually incur them, not necessarily when you actually pay. The bottom line is the accrual method wins the gold star. It is the most reliable method for running your business. It paints a complete, accurate picture, and it provides the information that you need to quickly make decisions. Thank you so much for watching. You know what to do. Subscribe, like, share, subscribe to my email. This is the perfect way for you to learn when I release new training videos just like this. And feel free to send me a direct message if you have any questions or if you would like to suggest a topic for my next video. Thank you so much.